School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 1 Accounting and Overview, Unit-2 Preparation of Books of Accounting, Part-1.
After completing this unit, you should be able to know the meaning and steps of accounting process, understand the meaning and importance of journal, and know the rules of journalizing. Introduction. A business enterprise generally prepares two basic financial statements. Number 1, profit and loss account, and number 2, balance sheet. Profit and loss account to ascertain the profit earned or loss incurred during an accounting period. Balance sheet to ascertain the financial position of the business as on a particular date. Generally, a business enterprise has numerous transactions every day during an accounting period. Unless the transactions are recorded and analyzed, it is not possible to determine the impact of each transaction in the basic two statements. Traditionally, accounting is a method of collecting, recording, classifying, summarizing, presenting, and interpreting financial data aspect of an economic activity. The series of business transactions occurring during the accounting period and its recordings refer to an accounting process or mechanism. An accounting process is a complete sequence of accounting procedures which are repeated in the same order during each accounting period. Accounting process involves certain steps or stages. They are: number 1, identification of transaction. In accounting, only business transactions are recorded. A transaction is an event which can be expressed in terms of money and which brings change in the financial position of a business enterprise. An event is an incident or a happening which may or may not bring any change in the financial position of a business enterprise. Therefore, all transactions are events, but all events are not transactions. A transaction is a complete action to an expected or possible future action. In every transaction, there is a movement of value from one source to another. Transactions may be external, that is, between a business entity and a second party. For example, goods sold on credit to Hari. Or transactions can be internal, that is, they do not involve a second party. For example, depreciation charged on the machinery. Number 2, recording the transaction. Journal is the first book of original entry in which all transactions are recorded event-wise and date-wise and presents a historical record of all monetary transactions. It may further be divided into sub-journals as well, which are also known as subsidiary books. Number 3, classifying. Accounting is the art of classifying business transactions. Classification means statement setting out for a period where all the similar transactions relating to a person, a thing, expense, or any other subject are grouped together under appropriate heads of accounts. Number 4, summarizing. Summarizing is the art of making the activities of the business enterprise as classified in the ledger for the use of management or other user groups, that is, sundry debtors, sundry creditors, etc. Summarization helps in the preparation of profit and loss account and balance sheet for a particular fiscal year. Number 5. Analysis and interpretation. The financial information or data as recorded in the books of an account must further be analyzed and interpreted so as to draw useful conclusions. Thus, analysis of accounting information will help the management to assess the performance of business operation and forming future plans also. And number 6, presentation or reporting of financial information. The end users of accounting statements must be benefited from analysis and interpretation of data, as some of them are the stockholders and other one the stakeholders. Comparison of past and present statement and reports, use of ratio and trend analysis are the different tools of analysis and interpretation. Analysis of business transaction. Accounting process starts with a business transaction and is followed by analysis of the transaction for the purpose of classification and recording of the transaction. Once the transaction is recorded, similar type of transactions are summarized and the net figure arrived is taken to the financial statements. Voucher. Accounting is a process which starts and includes steps right from recording of business transactions of monetary character to the communicating or reporting the results thereof to the various interested parties. The first step in the accounting process is to analyze the transaction and record it on a pre-designed slip, giving details of accounts to be debited and credited. Since vouchers provide an evidence of transaction, source documents are also attached to the accounting voucher. Entries in the journal are done on the basis of vouchers and control accounts are also maintained on the basis of vouchers. A proper voucher system ensures minimization of errors of omission and commissions. Each transaction is recorded in books of accounts, providing all the required information of the transaction. Since each transaction has an effect on the financial position of the business, there should be a documentary evidence to establish the monetary accounts at which transactions are recorded, and also the transactions are properly authorized. The common documents that are generally used are: Number 1. Payment voucher. A payment voucher is usually on a printed standard form and it is a record of payment. When payment is made for an expense, generally a bill is prepared to record full particulars of the claim by the person or organization receiving payment. From the bill, the accounting department prepares a voucher for each payment to be made, no matter whether the amount that is paid for the goods purchased, or to pay employees' salaries, or to pay for services, or to pay for any other asset acquisition. Number 2. Receipt voucher. A receipt voucher is a document which is issued against cash receipts. It may also be a printed standard form. This document shows that a certain sum of money was received from a person or organization and also contains information of the purpose for which the money is received. It is signed by a responsible employee authorized by the management to receive the money. Number 3. Transfer voucher. A transfer voucher is used to record the residuary transactions. An internal transaction or a transaction not involving any cash payment or cash receipt is recorded in the transfer voucher. Examples are goods purchased on credit, depreciation of assets, outstanding expenses, accrued income, etc. An overview of the balance sheet. Let us understand the concept of a balance sheet with the help of an example. Mr. Raghav is the owner of a startup firm RT Limited. On 1st April 2020, the position of his business firm RT Limited is as follows. He has invested his personal savings worth rupees 10 lakh cash into the firm as capital to start the business. He also took a loan from bank of an amount equal to rupees 3,50,000 for buying an office premises for his business firm. Further, he purchased some machinery worth rupees 2 lakh and a motor car worth rupees 3 lakh for the operations of the firm. To start the business operations, he brought in the inventory worth rupees 2,50,000 and kept an amount of rupees 20,000 as cash and also deposited an amount of rupees 50,000 in a savings bank account for the purposes of business. Apart from this, Mr. Raghav invested the remaining amount of rupees 1,80,000 in government bonds on behalf of his firm RT Limited. Now let us generate a balance sheet for RT Limited as on 1st April 2020 on the basis of given information. We will classify the given information into the resources owned by RT Limited and the claims against those resources. The commonly accepted format of balance sheet in India shows liabilities on the left-hand side and assets on the right-hand side. As we have already discussed, a balance sheet is always prepared from the point of view of a business entity and not the owner. Hence, the balance sheet or the position statement of RT Limited as on 1st April 2020 would be presented in the set format. Here we can see that the total value of resources owned by RT Limited, which includes building, machinery, car, cash, investments and inventory, is worth rupees 13,50,000. In accounting, these resources owned by the business are referred to as assets. Further, we observe that the claims against these resources in the form of a bank loan stands at rupees 3,50,000. Such claims against business entities' assets are referred to as liabilities. Now the net worth of RT Limited will be calculated by deducting the claims against its worth from its total worth of resources, which is an amount equal to rupees 10 lakh. That is 13,50,000 minus 3,50,000. Thus, the net worth of an entity represents the claim of its owners, which is also referred to as owner's equity. We also learned that the items of monetary value possessed by an entity are referred to as assets, whereas the amount owed by an entity which represents claims against its assets by outsiders are called as liabilities. Thus, we can say that the position statement is a summary of the assets, liabilities, and net worth of an entity at a specific point of time. Classification of accounts. Personal accounts. Accounts which are related with accounts of individuals, firms, companies are known as personal accounts. The personal accounts may further be classified into three categories. Natural personal accounts, like accounts of individuals relating to natural persons, such as Akhil's account, Rajesh's account, Sohan's account, they all are natural personal accounts. Artificial personal accounts. Accounts of companies, institutions such as Reliance Industries Limited, Loyns Club, Messrs. Shyam and Sons, National College, they all are artificial personal accounts. They exist only in the eyes of law. Representative personal accounts. The accounts which represent some person, such as wage outstanding account, prepaid insurance account, and accrued interest account, are considered as representative personal accounts. Then comes real accounts. Real accounts are the accounts related to assets or properties. These may be classified into tangible real account and intangible real account. The accounts relating to tangible assets such as building, plant, machinery, cash, furniture, etc. are classified as tangible real accounts. Intangible real accounts are the accounts related to intangible assets such as goodwill, trademarks, copyrights, franchisees, patents, etc. The third type of account is nominal account. The accounts relating to income, expenses, losses and gains are classified as nominal accounts. For example, wages account, rent account, interest account, salary account, bad debts account, etc. Learners who are studying accounting for the first time would find it difficult to classify the accounts on the basis of the explanation that I have just given. But you would be able to classify the account on the basis of asset, liabilities, expense and income if you understand the dual aspect concept and accounting equation approach that we are going to discuss now. Dual aspect concept. Let us take a step further in the previous example. Suppose Mr. Raghav purchased some goods or raw materials worth Rs 10,000 in cash. This transaction will have a dual impact on the balance sheet of RT Limited. First, the inventory will increase by Rs 10,000 and second, the cash balance will decrease by Rs 10,000. Similarly, if the goods were purchased by Mr. Raghav on credit for Rs 10,000, the inventory or asset will go up by Rs 10,000, whereas the creditors will also increase by Rs 10,000. This brings us to a fundamental accounting concept known as dual aspect in accounting. This concept explains that each transaction made by a business entity impacts a business in two different aspects, which are equal and opposite in nature. It means that every business transaction will affect at least two accounts, which imply that for every debit there is an equivalent credit and vice versa. For example, if your company borrows money from the bank, the company's asset or cash is increased, that is debited, and the company's liability or notes payable is also increased, that is credited. It is because of this feature that both sides of assets and liabilities of the balance sheet will always be equal. This concept forms the basis of double entry accounting and is used by all accounting frameworks for generating accurate and reliable financial statements. The dual aspect concept is also explained in the fundamental accounting equation, which is assets is equal to liabilities plus owner's equity. The accounting equation indicates that an entity's assets have to be equal to the sum of its liabilities and owner's equity. This equation is considered to be the foundation of double entry system of accounting. It ensures that every entry made on the debit side has a corresponding entry made on the credit side and vice versa. Hence, the double entry made will automatically balance the accounting equation. To sum it up, we can say, number 1, an increase in assets is followed by an increase in liabilities and or equity and vice versa. Number 2, a decrease in assets is followed by a decrease in liabilities and or equity and vice versa. Number 3, an increase in an asset is followed by a decrease in another asset and vice versa. And number 4, an increase in a liability is followed by a decrease in another liability and vice versa. Now let's consider a series of examples to explain this concept further. Mr. Raghav further invested cash worth rupees 4 lakh into his business RT Limited. The effect of this transaction will be capital will increase by rupees 4 lakh on the liability side and cash will also increase by rupees 4 lakh on the asset side. Also, Mr. Raghav repaid the loan in cash he took from bank for his office building worth rupees 3,50,000. This transaction will again have a dual effect. Loan from bank will reduce by rupees 3,50,000 on the liability side and cash will also reduce by 3,50,000 on the asset side. Lastly, Mr. Raghav sold the investments he made in government bonds for rupees 2 lakh cash. In this transaction, RT Limited made a profit of rupees 20,000 as the gold bonds were purchased for rupees 1,80,000 initially. The effect of this transaction will be number 1, investment in government bonds will reduce by rupees 1,80,000 on the asset side. Number 2, cash will increase by rupees 2 lakh on the asset side. Number 3, profits of rupees 20,000 will be shown by an increase in the capital on the liability side. Hence, a balance sheet will always balance its two sides. The effect on one account will be compensated by an equal and opposite effect on the other account. Accounting equation approach. The basic accounting equation is assets equal to liabilities plus capital. In this equation, assets refer to the resources owned by the business enterprise, that is, resources owned by the owners of business enterprise. These resources are expected to generate future cash flows and earnings for the business. Liabilities are the claim of the others on the assets of the business, or in simple terms, it is the debt, outstanding expenses payable to various stakeholders. Capital means the amount which is payable by the business enterprise to the owners of the business. In brief, the assets are the resources which business enterprise owns, and capital and liabilities are what business enterprise owes to others. This mentioned equation forms the basis of double entry system of bookkeeping. Every transaction recorded under this method has dual effect, viz. It affects two accounts simultaneously. For example, furniture worth rupees 5,000 is purchased in cash or credit. Now, when the furniture is purchased in cash, two accounts are affected. Cash, which is an asset, decreases by rupees 5,000 and furniture account, which is an asset, increases by rupees 5,000. In the second case, when furniture is bought on credit, again two accounts are affected. First, furniture account increased by rupees 5,000 and a new liability of rupees 5,000 is created. Thus, the increase in liability of rupees 5,000 is also there. In a nutshell, every business transaction will have a two-fold effect. If there is an increase in a particular asset, the counterpart of that transaction would be a decrease in some other asset or creation of decrease in some other asset or creation of new liability. This is also known as dual aspect concept. From this example, it is clear that effect on one account will be compensated by an equal and opposite effect on another account or accounts. When we use accounting equation approach for recording business transactions, all accounts are divided into three categories. namely asset account, liability account, and capital account. Now let us understand the basic rules used for recording changes in assets, liabilities, and capital. Rule number 1. For recording changes in assets, increase in assets is debited and decrease in assets is credited. Rule number 2. For recording changes in liabilities and capital, increase in liabilities and capital is credited and decrease in liabilities and capital is debited. To understand this, let us assume that you have started a business on 1st April 2021 with rupees 5 lakh in cash through your firm Messrs. Myself. Now you are able to understand how to record transactions for change in assets and liabilities. Now we are going to discuss how to analyze and record changes in capital account. The capital account increases due to introduction of new capital, revenue, and income earned. It decreases due to withdrawal of goods, cash, and other assets for personal use and expenses incurred. Recording all these transactions directly into capital account will make it cumbersome and unwieldy. In practice, all the revenue and expenses are taken to profit and loss account and the net effect is transferred to capital account. In the same way, cumulative effect of drawings is recorded in capital account at the end of the accounting period. For recording the items of revenue and expenditure, temporary capital accounts are created. The reason behind calling these accounts as temporary capital account is that each of these accounts starts with a zero balance at the beginning of the accounting period and at the end of the accounting period, these accounts are closed and their balance are transferred to profit and loss account and the net balance or net profit or net loss is transferred to capital account. The temporary capital accounts include number 1. Revenue account including some other income and gains. Number 2. Expenses account including losses. And number 3. Drawing account. Increase in revenue leads to increase in capital. Therefore, revenue earned is credited to revenue account. For example, sales of rupees 10,000 in cash. In this case, cash account would be debited by rupees 10,000 and sales account would be credited by rupees 10,000. Expenses decrease capital and decrease in capital is debited. Therefore, expenses incurred are debited to expense account. For example, purchase of rupees 9,000 in cash. In this case, purchase account would be debited by rupees 9,000 and cash account would be credited by rupees 9,000. Now let's take an example. Analyze transactions of Messrs. Sunil and Company for the month of March 2021 on the basis of double entry system by adopting certain approaches. These approaches are accounting equation approach and traditional approach. Now, transactions for the month of March 2021 were number 1. Sunil introduced cash rupees 40,000. Number 2. Cash deposited in the Citibank rupees 20,000. Number 3. Cash loan of rupees 5,000 taken from Mr. Y. Number 4. Salaries paid for the month of March 2021 rupees 3,000 and rupees 1,000 are still payable for the month of March 2021. And number 5. Furniture purchased rupees 5,000. What conclusions one can draw from this analysis? Illustration 2. Now we will show you the classification of these accounts under traditional and accounting equation approach. Now what these accounts are? Building, purchases, sales, bank deposit, rent, rent outstanding, cash, adjusted purchases, closing stock, investments, debtors, sales tax payable, discount allowed, bad debts, capital, drawings, provision for depreciation account, interest receivable account, rent received in advance account, prepaid salary account, provision for bad and doubtful debts account, stock reserve account, and provision for discount on creditors account.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Ruchi Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.